Thank you very much, Tom, and thank you to everyone for coming. I should mention to the large number of people in the audience who aren't part of the activities that we've been holding for the last 2 days in CAMA, that this lecture is part of the 18th Macroeconomics Workshop being held this year at ANU. It's an excellent workshop that's been run now for 18 years. In fact, CAMA, which is the centre that I established 10 years ago, was launched at this workshop exactly 10 years ago at ANU. So that's the reason I agreed to give a lecture. Initially because I thought I'd have 30 of my closest macroeconomics colleagues to talk to about technical modelling, but now I discover that it's become somewhat larger than that. So it will be a fairly technical presentation, no equations, but there'll be a lot of economics. So you're welcome to leave now if you wish. And I should also mention, and I'll thank some of the organisers of the workshop at the end. So I posed a question here, as Tom said, and it's fairly straightforward what my answer will be. The answer is clearly yes, and as with most economics, it's always relative to what? And relative, if you don't have a model to think through complex systems, I wonder how you do it. So yes, I think models are useful. There's a lot of problems in the existing models, but then models aren't perfect. So what I want to do in this presentation is just talk about how I think models are useful, talk about a particular model, which is the model that some of you would know as the McKibben-Sachs global model from many years ago that has become known as the G-cube model, as we've done a lot more development with Peter Wilcoxon, my principal co-author. What I want to do is give you some insight into how we model the GFC from a paper we were writing in real time actually in 2009, which was published in 2010. But sitting on a board of the central bank in the middle of the GFC, it was hard to get a handle on what was going on, so I was running a whole pile of simulations which ended up in this paper. And although the paper was predictive, it does give you some insights which influenced my decisions on the board of the bank at that time. Then I want to look forward, and I want to look at some of the big debates and whether what this model in particular tells us is important. One is, what are the implications of a global fiscal consolidation? That is, countries credibly committing to long-term fiscal adjustment. What happens if there's a big change in country risk? One of the things you find in these types of intertemporal models, and I'll talk a little bit more about that in a minute, is that changes in risk perceptions have massive impacts on the real economy. And I think that's an area where research needs to be heading and understanding that better. And I'll talk about what happens when the euro splits, and well, if it's a messy split versus a non-messy split, and I'll give you a conclusion. So there is a philosophical debate going on since the financial crisis, and that is, was it really an economic crisis or was it a crisis in economics? There's a very popular view out there, particularly on the internet, that all our economics was wrong, we need a new framework, we need to throw away all this empirical knowledge that's embedded in all of these models of all types, and we need to start all over again because the economists just don't know how the world works. My view is actually obviously not that. My view is that our current frameworks work well, but they need a lot more disaggregation. I think what's wrong with macroeconomics is for certain questions is that we don't have enough relative prices. So when we get a big change in relative prices, whether it's the price of money today and tomorrow or the price of oil versus other sources of inputs, the models break down as they did in the oil price shocks of the 1970s. And so I think what we need is a better understanding of how we get more relative prices into macroeconomics, but also, and it came out in some of the presentations, Tim gave a paper this morning on business cycles, it is the case that a lot of the stuff that's happening in economies is hard to predict because it's the shocks themselves that are driving things. And so the question is to get a better understanding of the shocks. So what is a model? Well, the world is a very complicated place, and it's a mix of natural systems, it's a mix of human behaviour. And what a model is fundamentally is a way of simplifying this complex world, and it uses information like identities, which are in a sense facts, that A equals B plus C, but it also has a lot of assumptions in there about how people behave, about how markets work, about how a whole range of behavioural activities play out. And the best way we find is to try and use as much information on observing behaviour, estimating equations, estimating behaviour and putting those in the models. But again, in the end, a model is just a model. It's just a simplification of a complex world. The danger you face, though, is when the model is a black box. Because once there's a black box, you can't understand the stories that the model's throwing up, and therefore you really can't understand how you should respond to very complex phenomena. Now, a lot of the work that I do is actually using models not for forecasting, although there is a role for forecasting, but not with the type of model that I'll be talking about. It's more to do with scenario analysis. What if? What if Europe collapses? What if there's a major pandemic? It's a way of organising your thoughts in thinking through how do you design the scenarios to go into a model, and it's a way of understanding what's the model telling me about what are the key sensitivities in here, what are the key areas that we have to worry about if we're trying to understand what's evolving in the world. There's a lot of shocks that are occurring that you need a model to understand. Shifts in economic policy, changes in risk premia, and you can actually observe some of these. As risk premia change in real time, you can see them being priced in markets, and that's the basis of some of the work we did, even going back to the Asian financial crisis, which this model actually gave the opposite conclusion to many, and that was Australia wouldn't have a recession because the capital allocation in the world would offset the trade effects. And there's a lot of shifts in demand and supply curves, and the models themselves at least let you track through what might happen as a result of that. Now let me talk about a particular model, although there are many models out there and they've all got a lot of different strengths and weaknesses. This model has a lot of weaknesses, but it has a couple of strengths, and I'll just talk through. There's two main papers. If you're interested, you can get them from my website. One is the original paper on the model, which was published in Economic Modelling in '99, and the new paper that's just been published in the North Holland Handbook of CGE Modelling, where we managed for some reason to be given a whole chapter to write about what G-Cube can tell us about energy and the environment. So what is the G-Cube model? It's what I would call a hybrid of a DSGE macro model and an intertemporal general equilibrium model, which is very common in the computable general equilibrium or CGE literature. And the model's quite unusual in the sense that a lot of the key elasticities of substitution in production and consumption at a fair degree of disaggregation have been estimated. And then the model itself, because it's very large, it's about 15,000 equations, there's a lot of data that's needed that you haven't got. So we have to do a lot of calibration, and we do as much estimation as we can. But one of the key driving forces is it is a modern macro type model where households are maximising intertemporal utility. That is, they care about their utility today as well as their utility in future years. But not everybody's always optimising. And so we have 30% of households are doing this very clever optimisation. They've gone out and they've bought the G-Cube model and they run it every day and they update all of their forecasts. But most people don't do that. And so a lot of people, they've worked out what the optimal rule would be in the steady state, and they don't update their information sets over time. But in the long run, everybody's the same. And the same sort of behaviour is modelled for firms, where some firms are maximising their share market value and some firms are just spending out of cash flow. All firms are facing quadratic adjustment costs. That means that you can't accumulate capital too quickly, because the quicker you invest, the less actual capital you're going to get for future production. So they tend to try and smooth their decisions on investment. And that they're facing evolving technology over time. Now, what are the key features of the model? And again, it's a very big model, and obviously, even if you're a modeller, you probably would spend quite a lot of time reading the literature to understand what this model does. It's not featured in the macro literature because it's not a macro model in the sense of it's more than 3 equations, but it does have a macroeconomics closure. So it's an annual model, it's a dynamic model, it has full intertemporal closure. What that means is that the budget constraints facing a household isn't just current income, it's future wealth. So households are constrained that they can only spend up to a certain amount and borrow up to a certain amount. The same applies to firms and to countries. And there are many markets. There are markets for many different things, for energy, different types of manufactured goods, mining, agricultural services. There are different inputs. There's capital and labour, there's inputs of energy, there's inputs of materials. And there are markets for financial assets, equities, bonds, money. Countries of people are trading money, bonds, equities across borders. They're trading goods and services across borders. So it's a CGE sectoral disaggregation in the sense that there are many sectors and many agents, but there's a sort of very conventional intertemporal modern macroeconomic framework overlying it. Now, what's important and what shows up in some of the results and some of the stories is that the macroeconomics doesn't just drive the sectoral allocation, and the sectoral outcomes don't just drive the macroeconomics. These two things are simultaneously determined. So the more they do macro in the current debate about energy or about financial crises, the more you see that there's a big interdependence between shifts in relative prices and macroeconomic outcomes. Another feature about the model is it's not in equilibrium in the short run. So the steady state, or the long run of this model, starting from today, is many hundreds of years into the future, which makes it a very challenging tool to try and work with. In the very long run, it's a very standard, conventional neoclassical model. Some people won't like that because they believe in the very long run the world's not neoclassical. I'll wait until we get there to find out who's right. It is, however, a useful assumption to make to tie down a lot of these forward-looking characteristics. Now, what's interesting is that even though we can talk about the long run and we can model the long run, and when it comes to applying this model to climate change policy, you're talking about some pretty long-run time dimensions. The model's actually more interesting in the short to medium run. And what's happening in the short to medium run is what happens if you throw a lot of stickiness into a fairly standard general equilibrium model. And where the stickiness is thrown in this model is in the adjustment costs of physical capital accumulation. You can't instantly take a nuclear-fired power station and turn it into a shoe factory. You can't instantaneously build an entire city because it takes time to do it and there are costs in doing things quickly. We also have a lot of imperfections in the labour markets. Wages are sticky. There's a wage equation which is country specific, but where basically wage setters have got a contracting framework where they base their wages next period on future inflation, previous inflation and overall labour market conditions. And markets, as I mentioned, all markets consist of two types of agents. There are those agents who know the model and use the model, but they're a minority. There's a bunch of agents who just have a rule of thumb, which in the steady state is consistent with what the forward-looking people are doing, but actually in the short run means that they will respond when they see things in front of them, even though there's a lot of information out there about what might happen in the future. And there's a lot of just generic imperfections. In fact, to get a model like this to actually replicate the data today, which is something you need to do when you start off, you need to throw a lot of imperfections like risk premia, equity risk premia, country risk premia. To get all the asset prices to line up, it's a fairly complex process to work out what the risk premia are. But once you've done that, you can shock the risk premia and you can see what happens if these things move around as they do. And finally, there's a lot of institutional rigidities that we model. So the US and India aren't the same. India has a whole bunch of different institutional characteristics. The Chinese exchange rate system is a different institutional setting for monetary policy than the Fed and the ECB and the Australian Central Bank. So the institutional characteristics, as much as possible, we build in. Now, in the version that I'll be using for most of this analysis is this version with this one has 15. Sometimes we throw New Zealand in there for the Kiwis in the audience, and sometimes we don't. It turns out our New Zealand model misbehaves quite a lot. It's a very hard economy to model. I don't know if it's because the agricultural sector is such a dominant feature, or the energy structure is so much non-fossil based. But whatever it is, we use it when we work on New Zealand, but because New Zealand shouldn't be driving the world, we take it out when New Zealand's misbehaving. But this model has a lot of developing country coverage, a lot of industrial country coverage. There are many different versions of G-Cube depending on the questions we're asking. There's one version that we use for the Asian financial crisis, which has every single country in Asia. But by doing that, you have to compress the rest of the world because it's just too much technically to solve such a big system. Now, there are 6 sectors of production in each of those countries. They're all different. There's energy, mining, agriculture. There's 2 types of manufacturing, durable and non-durable, and then there's services. Now, the durable and non-durable split was done because in a model where agents are making decisions about housing investment or making decisions about buying consumption goods which have a long payoff period, they behave differently when there's a change in risk than the demand for, say, food or short-term consumption. So we decided once we started getting a lot of risk shocks in the world that the best split is durable, non-durable, and it does make a difference, as I'll show you. Another split, which we probably should be doing when we get to the climate change and energy work that we do, is rather than durable, non-durable, it should be energy intensive and non-energy intensive. But we have the flexibility to do those sorts of reallocations. Now, there's another sector in the model. When these firms in each of these industries are making their investment decisions, what they're doing is they're buying a capital good from a capital producing sector. So there's this other sector in the economy. It buys inputs from all over the world, the domestic energy markets, the foreign energy markets, and it creates a capital good for that period. And that's the capital good that all the sectors buy to build their investment for that period. So let's look and see what the model says, or how we think through, using a model like this, how do you think of the financial crisis. Now, when I say what is the core of the crisis, I think everyone in this room probably has their favourite trigger or their favourite explanation. Financial frictions, lack of supervision, a housing crisis, etc., etc. What I'm going to talk about is what we need to identify to do a pretty good job of understanding the scale of what happened. Now, one is the collapse of the US housing market, and the key mechanism for that, and I'll go through that shortly, is when the US housing market collapses, it changes household wealth, it changes consumption, and that causes a slowdown in demand, and that causes a trickle right through the economy, which makes housing far more important than just its share of GDP in production. And what was key is that there's a rise in risk perceptions. This wasn't hypothetical, you could see it in markets. And the question is, when you see those sorts of things happening in this sort of model, what happens? And risk plays an important role in an economic model, because it's not just people say, oh yeah, it's riskier. It actually changes the rate of return that you need to get on your future capital. So if the risk goes up, you're going to have to generate a much higher rate of return on capital, which means you need to drag back your capital stock. You need to shed the capital that's not as productive, and you need to contract the capital stock. Now, as you'll see in some of the graphs, a small change in risk means a big deleveraging or a capitalisation of your economy. And as well as all this, you see stock markets collapse, and you see a whole bunch of things happen which drive real behaviour, which then drive the macroeconomic outcomes. And the third thing that we found was useful or needed to be wasn't just the risk perceptions in the equity markets, but actually the fact that households change the rate at which they discount their future income streams. So if households if they think the world is more risky, when they're working out their wealth, they're using a higher discount rate, so the value of their wealth will contract, and that leads to fairly substantial changes in consumption. So just to show you how much housing markets collapsed in the US, this is just a chart of US house prices. It's been scaled to per capita income, but you can see this massive run-up from 96 to, from 96, yes, to 2006, 2007, and then this massive collapse in the value of houses in certain markets. So this was a period of a very large bull run in the housing market, then a collapse. Now, we do have housing in the model, and the question is, how do you... We don't do the run-up in this particular analysis, but we do the collapse at the end. The other thing that you can measure pretty quickly is looking at what happens to corporate bond spreads. This is the spread between corporate bonds and government bonds with a 3 to 5 year maturity. And you can see that we always thought that 2001 to 2002, which was the dot-com bubble burst, was a pretty bad time for risk. That's the left-hand part of this chart. But if you look at the change in risk that was occurring from 2007 through 2008 as Lehman Brothers collapsed, risk was moving by 600, 700, 800 basis points. Now that's a massive change in risk, and the question that's interesting is, suppose, and we were observing this at the time, and they said, what happens if we stick that into our model? So the question is, suppose we stick this into the model, what sort of things do we want to try and explain? Well, one is the collapse in durable good demand, which was really quite interesting, and I'll show you a chart for that. Basically, people stopped buying durable goods. And this was a massive shock to some economies who produce those goods. Secondly, GDP and investment really collapsed in many places. And the third point, which is kind of interesting, was that the fall in world trade that we observed was much, much larger than the fall in GDP. And so the question is, can we shed some light on that? And this is just a chart that shows you for the US what happened to durable good demand, which is the pink line. You can see that it fell about 20% in a very short period of time. So that's the sort of story that comes out of a macro model with these intertemporal features if you've split your goods between durable and non-durable. So what I'll show you now is some results from a paper that came out in the Oxford Review of Economic Policy in 2010. So this is from stuff we were doing in 2009. What we should now do technically, and actually we should go back and see how right we were. I mean, this is like a forecast rather than an explanation. But in fact, we haven't done that yet, but we should. So in breaking down the shocks and looking at what was going on at the time, we could see the different things happening in different countries. We had a crisis, a financial crisis in the US and the UK. The financial systems were freezing up. In other countries, this wasn't really an internal financial shock. It was that their exports were starting to fall. That was an endogenous response to the financial crisis. And we saw a loss of confidence throughout the world. So we had leading politicians from both sides in Australia coming back and saying the world is coming to an end. We had speeches being given about this was the Great Depression, this is the end of capitalism, this is a really bad outcome. Well, of course that undermined confidence. And again, finally, it's not just a supply shock or a demand shock because of insufficient demand. It was a very complex shock which consisted of both supply and demand shocks. So we considered two scenarios, and what I'll talk about, one is, because at the time you didn't know whether that risk premium shock was actually going to last forever, or was it going to go away tomorrow? So we looked at two shocks. One was a permanent shock, and one was the case where you thought it was permanent, but a year later you discovered that it was temporary. So there's actually three: a permanent shock, a temporary shock, and a shock you thought was permanent that turned out to be temporary ex post. And then there's other papers we've published in other journals that look at a whole bunch of expectation issues. Now, without getting too technical, the way that we then did this was we said, okay, how do you define the permanent shock? And we defined it as a change in equity risk premium by sector. So what we have down here is what the shock is on the left, and the numbers are what the shock in that sector would be in 2009. And again, this is just for the US. And then how much household risk changed, people's expectation about their future income stream, how much do we change the risk at which the rate at which that's discounted. And then the final shock is this household productivity shock. And what that was picking up was the idea that because in that run-up, people were building and buying houses because they expected a future flow of return on those investments. And what if you got to the peak and all of a sudden the productivity of that housing service you created collapsed by 10%. So instead of thinking that the house was giving you a very high value of services and therefore the house was very valuable, all of a sudden those flow of services were much, much less than you thought, and therefore you ended up with this overshooting in expectations. But nonetheless, it meant that the housing values would collapse because the value of the house is the present value of those flow of services. Now that's just a generic set of shocks. We then, and in this temporary scenario, we did exactly the same in the first year, but then in subsequent years it phased out. So in all the three shocks, in all the three scenarios I'll show you, the first year effects were exactly the same. The shocks were exactly the same, but what's happening in the future is expected to be different. What we then did was say, okay, this is a generic shock, now let's allocate it across the world. So we put weights on different countries so that some of these shocks were scaled up, some of them were scaled down, and so we could then get a full set of shocks for all countries, for all sectors to track it through the model. Now obviously you probably couldn't even read that, but there's a lot of work went into this. Now and the beauty of a model again is that you don't have to do it all at once. So the beauty of a model is you can say, let's unpack this and let's understand what each component is telling us. So the first bit of unpacking is to do what actually we thought when I was on the board of the RBA was what was happening in 2007, and that was this is just happening in the US. We don't expect the rest of the world is having this shock. This is the US housing market. We knew it was going to collapse. It was inevitable it was going to collapse. Okay, now it's collapsing. What happens if it's just in the US? So think of the GFC shock then is the housing shock plus the financial risk shock plus the household risk shock. Now it was more than that. Clearly it was more than that, but these are the three components that we're just going to look at. Now, this is where I'm really going to stretch the eyes of those who are the same age as myself and older. And in all the charts from here on in, I want to be very clear about what you're looking at. So what you do with this type of model is you run the model for a long period. You then change the shock or change something. You run the model again, and then you take the difference. So what these charts I'll be showing you are the difference to what would have happened compared to what does happen as a result of the experiment. So a 0 means nothing's changed. Below 0 means something's got smaller, and above 0 it's got bigger. So if you look at US GDP, if you look at take the green line, the top, that's what happens in the US purely as a result only of the financial shock. The pink line is what happens as a result of the housing shock. The blue line shows you what happens as a result of the change in households' discounting of the future revenue streams. And the red line, called the GFC, is what happens if all these shocks happened at once, which they did. So you can see the US housing shock, which is the pink line in itself, this is showing that GDP is 3% lower than it would have been. So these are not growth rates, these are percentage differences from what would have been the case. So what this says is that the US housing shock by itself was enough to cause a recession, a normal conventional recession in the US. If the US was going to be growing at 2.5% in that year one, it's now going to be 3% lower than that, which is a 0.5% fall in the growth rate. So the US would have gone into recession, but with the housing shock alone. Where's that coming from? It's coming pretty much from the change in US consumption because of the wealth effects of the fall in the housing market. It comes about because that has some effects on the US stock market. As housing prices fall, people are... the recession that's going to be following causes the value of the firms to drop. But you can see for the stock market, the bigger effects are coming from the financial risk shock. So if you put a change in equity risk premia so people don't want to hold equities, they're going to dump their shares and buy something else. What do they buy? Well, they buy government bonds. And in buying government bonds, they drive up the price of government bonds, drive down the real interest rate. And you can see that a fair bit of this story, and again this came out in a paper this morning at the conference, is that it's the investment that really takes the hit when you change risk. So you can see the investment responses here are really very big. 40% change in investment. And so the thing with, if you're going to try and tell the whole GFC cycle story as a change in investment, it's not enough because investment's too small part of the economy. You have to get the channels through consumption and through the trade accounts to get the big collapse in GDP. But here you can see that the sort of story that was coming out is it's showing you the scale of the story. Secondly, this is a shock that is assumed to be permanent for the US. So you can see that the GDP losses aren't just in the first year, they last for a very long period of time. And the story there again is the story of higher risk means a lower capital stock means lower future production. And here's the story on interest rates. The other story this model captures pretty well is the fact that when you do actually decide to dump all your assets, you actually not only move into US government bonds, you actually move into foreign assets. So the capital flows out, the US dollar depreciates, the US trade balance goes into significant surplus, and all this capital flows around the world, including into China, which causes Chinese trade balance to go into significant deficit. And this effect also pushes down Chinese real interest rates. Let me just skim through this. Just to show you that what happens to durable goods, I don't know if this chart will come out, but maybe not, you can see it. The blue line is what happens in this scenario to durable goods imports. So you can see imports of durable goods drop a lot, but production of durable goods drop a lot less. And the reason for this is that a lot of trade in the world, durable goods have a bigger share in world trade than they have in US GDP, and that's how you can capture the fact that trade collapsed much more than GDP. It's a durable goods story largely, at least in this model. Now let's take that particular scenario and say, okay, the shock we thought was going to be in the US, now let's apply those weighting factors to spread the shock around the world. So we've already talked about the transmission of the shock, but that's not enough. In fact, it's the opposite sign to what we observed in terms of what happens to other countries. According to this, a collapse of the US housing market eventually raises GDP around the world because all that capital that was in housing ends up in productive activities in other countries. Now, if you now take these risk shocks and propagate them throughout the world, you can see that the effects on the US, for example, is an 8% fall in GDP. In Japan, it's a 5% fall in GDP. It's a lot less in Japan. UK is having a financial crisis, so their GDP is contracting. But still, we've got other countries who are still benefiting from this financial crisis. So developing countries, you'd expect, would actually come out of this reasonably quickly. Now the question is, so there's three lines on, and let's focus on the top left-hand chart. The purple line is what I showed you before, except now I've got the whole world involved in this crisis. So GDP falls by 5% and it stays low for a very long time because this is a permanent shock. Everyone thinks it's permanent. The green line is exactly the same shock in the first year, but it goes away very quickly. And you can see the GDP effects are different, even though the shock's the same, because the expected future shocks are different. So you can see that if you thought this was permanent, you're far more pessimistic than if you thought it was temporary. And the blue line is, what if you thought it was permanent, then you roll the model forward 1 year and then you change the information set and people wake up and say, oh, actually it's temporary. You can see you do get a different dynamic because you've made all these adjustment decisions in capital allocation which you can't really simply unwind. So you can see that, again, this is now the global shock. The US stock market drops, real interest rates fall, investment collapses. The same sort of story around the world in terms of real interest rates. But basically the story is, as we think we can get a pretty good handle on the magnitude of what was going on during this financial crisis. Now, because I haven't got much time, I'm going to switch very quickly now to this issue of fiscal consolidation. as people should know, we have a serious problem in the world that government debt to GDP is well in excess of what would be regarded as sustainable. This chart shows you nominal government debt relative to nominal GDP in gross terms, and you can see this is a problem of the advanced economies. The orange line is the advanced economies' debt to GDP. The rest of the world is the blue and red lines, and you can see that if you believe 60% is a sustainable level, there's a big problem that needs to be addressed. This big problem that needs to be addressed is actually very disparate across countries. So this chart shows you gross government financial liabilities. Again, this is gross, not net, but the story is little changed. We have 3 bars for every country. These are all the countries in the OECD along the bottom. The blue line is what the debt was in 2007. The red line is what was added between 2007 and 2010, and the green line is what was expected to be added up until the end of this year, as estimated by the OECD. So you can see on the left, you've got Japan, as we've heard about yesterday and today, has a serious problem. But Greece, Italy, Iceland, Portugal, Ireland, all these countries have a serious adjustment that's needed. So the question is, and I should mention Australia is right down here at the end. So you would not think that Australia really has a debt problem. We have a problem of wasting the debt that we spent, but we don't have a problem of having excessive debt. So what we did then, and this is a new paper with Yingying Liu, who's probably in the audience somewhere, one of my PhD students, and Andy Stokel, looking at what happens if in fact countries try to do something. And the thought experiment that I'll talk about now is, suppose that you do what the IMF has recommended and you cut fiscal deficits equiproportional with cuts in spending and increases in taxes, so that from 2011 to 2020 you get the debt to GDP ratio or the deficit down sufficiently so that you stabilise debt to GDP at 60% by 2030. And the question then is, well, what will this do? Because if you're a pure Keynesian, you'd think that would be carnage because these changes are very large. The question is, does the timing matter? And that's what I'll focus on right now. This is the change in the deficit that's required by 2020 if you started in 2012, which is already a year late. Japan needs to turn their fiscal position around by 13% of GDP. That's 1-3. The US has to turn it around by 11% of GDP, although that's slightly out of date because the US has been growing a bit more quickly than the OECD forecast. But anyway, there's some very large adjustments. What's critical in this story, though, is 2 things. One is that within the OECD, some countries have to do a lot, and some countries don't have to do anything. So that's very asymmetric. Secondly, between the industrial countries and the developed economies, or the emerging economies, a lot of industrial countries have to do a lot. Emerging economies don't do anything. So this asymmetry straight away, if you think it through, means that there's going to be a lot of movements of capital, a lot of movements of trade flows, and a lot of fluctuations in real exchange rates because of the asymmetry in the adjustment. Interestingly too, you don't want to be sitting in the rest of the Eurozone having to do a big fiscal adjustment with a fixed exchange rate with a country that doesn't have to do very much at all, because the fixed exchange rate is going to force a massive monetary tightening at the same time as you're doing a fiscal consolidation. Now, there's a lot of results, but let me just skim through. So the first point is on the left again. This is the US, and this is what happens if credibly, and that's critical, credibly you announce this fiscal consolidation. If you do it in 4 years, notice that the green line is actually going up before it goes down. And the reason for this is, even though the government is cutting spending and raising taxes in the first year, the future cuts and the future changes are so big that the effects on future tax liabilities and the effects on bonds markets and equity markets actually cause the economy a mild stimulus in the first year. So the fact that the credibility and the future cuts are so big means the present value is positive, and that helps you in the first year. But in the second year, it's a Keynesian model pretty much. So you basically go into almost a mild recession. Now, if you cut more slowly, you can eliminate the recession, but you still get a fairly big slowdown because you've spread the cuts over a much longer period. Now, what's interesting is those countries in Europe and the US that are going through the adjustment, that capital is being freed up. The capital that was in the government we would have been borrowing is now being freed up, and as savings flows around the world, it flows into economies like Australia, and that raises our GDP. So even though we do take a negative hit on the trade in the second period and third period, we take a positive on the long-term bond rates and on the capital inflows, and that raises the GDP. And this is the point I made before. This sort of adjustment is great for Germany, because Germany is sitting inside the euro. The rest of Euro is doing a fiscal consolidation. The euro is weakening, so Germany gets this export impulse from the fact that they're free riding off the southern Europeans' weak euro, and their GDP goes up a lot relative to what it would be. And there's capital flowing into Germany. But you can see this story about what's going to happen if you do this it's really, again, a story of investment. As the government cuts back, the firms are looking forward and seeing this future hole, and therefore they're cutting back on investment because the backward-looking guys are dominating the forward-looking firms, and therefore you don't get the sort of offset for the investment rates. And again, the story with the fiscal adjustment is one about changing savings and investment in the US. The US is going to be saving a lot more, and most of that's going to flow overseas. So the currency is going to depreciate, the trade balance will improve, and those countries that are sitting on the sidelines are getting both trade effects, but they're also getting the real exchange rate effects from the capital flows. So the key insights from this is that fiscal adjustment is very asymmetric, and that's what makes this particular issue so problematic for policymakers, because they have to deal with the fact that big shifts in the current account is going to cause some countries to go down a protectionist route potentially. The exchange rate does matter. So the countries that are fixing to a country that's cutting are going to get a benefit, and countries that are fixing to a country that's not cutting are going to get into some seriously bigger cuts. I hope I got that around the right way. And finally, this is all about credibility. So the benefits all come from the credible future cuts. The costs all come from the current cuts. If you have no credibility and you start cutting today, then you're going to get a very big recession because you don't get the benefits of the future credibility. Now let me talk about Europe, and I'm fearing I will run out of time. As people should know, Europe is in a bit of a state of despair. If you look at what's happening to industrial production, you can see there's a shining star of Germany with a very strong economy, and the rest of Europe has gone through greater than the Great Depression. Now this is partly a result of the exchange rate mechanism, where Germany is benefiting from a weak euro and the rest of and strong productivity growth, and the rest of Europe is suffering from a lack of productivity growth and a set of policies which are driving them into an ever-deepening hole. Now, again, this shows you risk spreads because the risk story is a key part of the European crisis. This is not what you'd expect to see. This is the spread between two-year government bonds in Germany and all the other countries. In a common currency that's credible, you'd expect these risk spreads to be pretty much zero. And what you're seeing here is Greece off the planet, 180% interest at the peak. So what I'll show you here very quickly is what happens. This is actually a section from the handbook chapter on what happens if there's just nothing else happens but people just start to lose confidence in Europe. So this is a 300 basis points increase in risk in Europe. And the second scenario is, well, people look at Europe and say, well, that debt's unsustainable. And then they look for the next candidate who's got unsustainable debt, and they look at the US and they say, oh, well, look at them. They look very similar, don't they? And so we get contagion with the same risk shock. So this shows what happens to US GDP. You can see with the European shock, US GDP goes up, because even though, again, Europe goes into a recession and trade falls, the capital that flows into the US is enough to raise US GDP for a long period of time. If the US goes into a recession, then, has a loss of confidence, then the capital flows out of the US and Europe to the rest of the world, so the US goes into a recession. What's interesting is if you look at what happens in Germany, if Germany is going it alone in terms of having the crisis, that's the red line, pink line, they're actually better off if the US has a crisis as well. Because if the US has a crisis, there's less places for the capital to flee to. And my view is one of the reasons that we've seen this slow motion fiasco in Europe over the last 3 years is that Japan was in a mess, the US was in a mess, and those little countries like Switzerland and Australia and Canada that were doing okay couldn't absorb the sort of capital that would have fled Europe. So this is a different story. This means that there is a political economy story behind this, but unfortunately I haven't got time to talk about it. And again, if you look at what happens to long-term bond yields, this is real long-term bond yields. Again, if Europe has a crisis, US long-term bonds go down because capital flows from Europe to the US and more bonds are being purchased, which drives down the yield. But if the US has a crisis, then the opposite happens. And you can see in Germany, the same sort of story. The bond rates don't move quite so much because when the US is in crisis as well, there's not as much capital flowing into Germany. But you can see other countries benefit from these sorts of capital flows. So again, this is the outcome for Australia. The outcome for China is quite interesting. When Europe has a crisis by itself, China's GDP eventually rises. When the US has a crisis, China's GDP soars. Why is that? Well, that's because China's pegging to the US dollar. When the US has a crisis and the US dollar starts to collapse, China actually floods their economy with money to bring down the Chinese currency to be in parity with the dollar, and that's a massive monetary injection which causes Chinese GDP to go through the roof. So this is where the exchange rate mechanism in the very short term does actually make a difference. And again, this is an investment story. You don't want to have changes in risk in your economy because it destroys investment. Okay. Let me just do the final thing. So let's do a scenario where we divide the euro into the German euro and the piglet. The piglet is the Portugal, Ireland, Greece, Spain group of countries. They form their own currency. We keep the Central Bank of Europe, so the ECB continues to control monetary policy, but it controls a monetary policy where there's a wedge in the exchange rate. So it's a perfectly fixed exchange rate inside of Europe, but now you've got rid of the 30% competitiveness differential between Germany and the rest. And two scenarios. One is, what if you only split the currency? And so this goes really smoothly. Friday night, everything closes. Monday morning, everyone wakes up and you know that there's this new world. And there's no panic, there's no problems. All the accounting and legal problems have been fixed up in the Saturday and the Sunday. This is what you can do with a model. Okay. Now let's suppose that you do that, but people start to lose confidence in what's happening in Europe. And so that's the second scenario. This is from a new paper with Andy that's not published yet. So what's interesting here is take the euro split by itself. That's the green line. What's interesting here is if and the German people shouldn't be careful what they wish for, because what happens when you split the euro is the whole euro will actually change relative to the US dollar. But the German euro will appreciate substantially. The Southern European, or the piglet euro, will depreciate substantially. The depreciation is enough to give a kick to the Southern Europeans, so they actually get 2% higher growth in the first year. Germany goes into a recession, or not quite a recession. Yeah, it is a recession given their current growth rate. So if you split the euro and you do it carefully, Germany's going to go into a deep recession because they're getting their benefits from the competitiveness gains of being inside the currency. Now, if you throw risk on top of that and people start pulling money out of Europe altogether, this really does throw serious problems both into Germany, but particularly into the Southern Europeans. So you've got to be very careful how you do this, this exchange rate adjustment. Again, if you look at the euro split by itself, the green lines, it's not a big deal for most countries because most of the adjustment is occurring through the competitiveness within Europe. But if capital flows out of Europe, it's going to flow into Australia and the US, and you're going to get this GDP stimulus. So what do we learn? And this is coming to the end now, so I actually have gone over, that's good. You know, the world is a very complicated place. But these sort of large models where we understand the analytical framework, we understand the assumptions, you can vary the assumptions and see what happens. What's critical though is that you have these large models with a lot of relative prices. The modern macro literature is incredibly useful as part of this story on how to think about these changes in risk and these forward-looking behaviour. And we can use these models to give insights into how shocks will impact, what policies will do, what is the sensitivity of certain outcomes to certain policies. And I think that's certainly, I think I've made my argument that I think these models are very useful in both looking backwards and understanding what's happened, but also looking forward. But again, just to make a final bid is, I think there needs to be more relative prices, and what stuns me is in the American macro literature that most of the models don't even have an exchange rate because a lot of economists still see the US as a closed economy. The US is a medium-sized open economy. It's 20% of the world. I think that particular assumption, it makes it analytically easier to deal with the analysis, but it actually misses, I think, one of the key stories about how real exchange rate movements shift the production possibility frontier as well as everything else that it does. So in terms of the global policy debate, I think we need to beef up a lot of the domestic macro models, but I still think the modelling community has done a pretty good job in giving us the tools we need to help the policymakers make the right decisions, whether they listen to us or not. That's my website.